In this Q&A video, I'm going to be discussing gold, the peak analysis and the trough analysis, and when we should use one and when we should use the other and why. This is in answer to a few questions that we've received recently from subscribers to our Hurst Signals service asking about gold and why we have two analyses on our Hurst Signals system. So let's dive into it and take a look. Here is my Hurst Signals dashboard, and if I scroll down to commodities and metals, there we go, you can see that we have a gold troughs instrument and also a gold peaks instrument. Of course, both instruments are gold, but the top one here has been analyzed on the basis that the troughs of the cycles are synchronized, whereas gold peaks has been analyzed on the basis that the peaks of the cycles are synchronized. What does that mean? Well, let's take a look at the trough analysis. This is the overview chart. So, of course, we're presenting a longer term picture here. And you can see what you would normally expect from a Hurst cycles analysis. We have the troughs marked at the foot of the chart by means of these diamonds. That is based on the principle of synchronicity that Hurst defined 50 years ago, which tells us that the troughs of the cycles are synchronized where possible. It is impossible for both troughs and peaks to be synchronized because of the fact that the cycles have different wavelengths, of course. That's the principle of harmonicity, that the wavelengths are related to one another by a small integer value. But that's maybe getting a little complicated. The important point is that according to the discoveries that Hurst made 50 years ago, the cycles that influence stock markets, I should point out, are synchronized at their troughs. What that means is that the cycles experience their troughs at the same time, and that is why the markers that we use to mark the position of each cycle's trough in time, those are these diamonds, form these stacks at the foot of the chart, because of course each cycle is experiencing a trough at the same time. And you will see here that the longest cycle has had a recent wavelength of 7 years. Then, of course, the next shorter cycle has had an average wavelength of 41.8 months, and so forth down the list of cycles. Now, this is an interesting difference between the nominal model that we use to analyze stock markets and the nominal model used to analyze gold. In stock markets, we are used to using the nominal model that has a 9-year cycle, and then, of course, a 54-month cycle, and then an 18-month cycle. But Hurst dedicated a section of his cycles course specifically to the analysis of gold, and he discussed the fact that he had found different cycles were present in gold. And the nominal model that we work with here is a nominal model discovered by Silent One, a very experienced Hurst cycles analyst whose avatar was Silent One back in the days when people used to post on forums under avatars. His real name was John Eastreich. He was an expert Hurst cycles analyst, sadly passed away a few years ago. He became a good friend of mine, and he applied his Hurst cycles analysis very successfully to gold over many years. And the nominal model that he defined and worked with over many years of analyzing and trading gold was this one over here. Instead of a 9-year cycle, he worked with a 7-year cycle. Instead of a 54-month cycle, he had a 42-month, I think it was 42-month, it might have been a 40-month cycle. And instead of 18 months, I think the average wavelength of that cycle was 14 months. I stand to be corrected, but we did do a webinar about this subject many years ago now, and I will find the link to that webinar and post it in the description below this video so that you can see the nominal model that he was working with. At any rate, this nominal model is a model that has worked very well over many years for analyzing cycles in gold, particularly cycles that are synchronized at their troughs. And so that is the trough analysis that we perform with gold, and that looks like a regular and fairly good analysis. So what is the idea behind a peak analysis? Well, here is the overview chart of the peak analysis. The interesting thing about the peak analysis is that Hurst himself never suggested gathered that some instruments are better analyzed on the basis of cycles being synchronized at their peaks. But he did discuss the concept of peaks, and particularly marking peaks on your chart by means of these triangles. You'll notice that Sentient Trader uses triangles, which is what Hurst suggested doing. But he never suggested in any of his work, as far as I'm aware, that cycles might be synchronized at their peaks. This is an idea that was introduced when I was developing Sentient Trader. It is not an original idea of mine. It was an idea suggested by John Eastreich and also by Ray Tomes, who developed the harmonics theory, another cycle theory about the way in which cycles work in financial markets. And he suggested that some instruments are influenced by cycles that are synchronized at their peaks because of the different relationship that we have with those markets. It's a very interesting idea. Stock markets are generally considered to be instruments that represent optimism in the economy, perhaps. When stock markets are increasing, we are optimistic about what is happening in the economy, whereas some other instruments, gold is an example, or other precious metals, tend to be slightly different. When gold is increasing in value, we are probably feeling a little less optimistic about stock markets, and we're putting our hope for the future in the value of something such as gold. It's an interesting concept. At any rate, it relates to the cycles that we work with by means of the fact that it is fairly clear that in some instruments, the cycles that are influencing their prices are synchronized at their peaks as opposed to their troughs. Now, it can be a little complicated when first approaching Hurst cycles to suddenly see all of the markers up at the top of the chart, and it can be really rather confusing trying to figure out what is going on. For that reason, we usually choose to analyze an instrument with either troughs or peaks. But gold is a little different, and the reason for that is because there are periods of time when gold seems to respond very well to a trough analysis. If we switch back to the trough analysis quickly, you can see that this analysis makes quite a lot of sense. What do I mean by quite a lot of sense? What I mean is that the cycles look fairly regular. Notice the semicircles, they have fairly good regular heights to those semicircles. The 18-month cycle here, not quite so much. As you can see, there's some variation. But generally speaking, the trough analysis looks fairly good in gold. And when we switch back to the peak analysis, you will notice that the peak analysis equally looks fairly good. Here we have an important 9-year cycle peak. Goodness, that's quite a major peak that this analysis is suggesting occurred over here way back in 2020. But the important thing, again, is that we have fairly regular heights to our semicircles. What that means is that, of course, the wavelengths are fairly consistent. When the wavelengths are consistent in an analysis, it suggests that that analysis is a good match for price. What we're trying to do is we're trying to understand what is happening in price. And when the analysis matches fairly clearly what is happening in price, then we generally have reason to believe that the analysis is a good one. And you will find this happening time and time again with gold in particular, that both the trough analysis looks good and the peak analysis looks good. Of course, it's impossible for cycles to be synchronized both at their troughs and at their peaks, and that's a subject that is beyond the scope of this video, but I'm sure you can figure it out for yourself if you go through the basic steps of creating some cycles and synchronizing them at their troughs in an Excel spreadsheet, for instance. You'll notice that the peaks are not synchronized, and vice versa. If you synchronize the peaks, then of course the troughs are not synchronized. But gold is an interesting instrument because it seems to go through periods of time where the troughs work brilliantly, and then other periods of time where the peaks work brilliantly. There are some instruments, coffee is an example, where it is clearly influenced by cycles that are synchronized at their peaks. If you look at a chart of coffee, and I'm not going to get distracted and show you a chart of coffee here, but go and take a look at the chart of coffee and you will notice that the peaks are generally very sharp, single isolated peaks, whereas the troughs are rounded and clustered, a little bit like that. It's not a very good diagram, but these single isolated peaks are the clear sign of an instrument that is influenced by cycles that are synchronized at their peaks, as opposed to a stock market where you tend to get sharp isolated troughs and rounded clustered peaks. That is the clear sign of an instrument that is influenced by cycles that are synchronized at their troughs. Gold, as I've already said several times, is an interesting instrument because it goes through periods of time where the one works and then the other works, and both of them look pretty good. That is why in our Hurst signal system we have both of them. So how should we work with the fact that we've got two different analyses? The interesting thing is that they often work very well together, and you will notice that the trough analysis is suggesting that as a trough has just formed, price is going to move up, and then you take a look at the peak analysis and you see price is heading towards that particular peak. Sometimes they work really well together, other times they are contradictory. At the moment they are a little contradictory, which is probably why we've received these questions that have just in the last day or two come into our support system. So let's delve a little deeper and let's consider why you would work with one as opposed to the other. What I like to do is I will usually start with the trough analysis. And of course, bear in mind that on the Hurst signal system, you can change your instruments frequently. So you could be changing from a peak analysis to a trough analysis, and you can always move to the one that you feel is working best at the moment. Let's start with the 3-month view of the trough analysis. You can see, first of all, that we have influenced this analysis. There's that pin symbol telling you that one of us has influenced this analysis, and we have positioned the 18-month cycle trough over here in the first week of October. The first thing to notice is that we are getting very good clean M shapes in the price of gold that have elapsed since October this year. That's a very good clean M shape for the 80-day cycle. That's a sign that the cycles that are influencing gold very probably are working fairly well and are fairly accurately represented in this analysis. The next thing that we notice about this analysis is that we have fairly regular cycle placements. The phasing of the cycles is fairly regular, and underneath the price, the troughs that are marked by these diamonds fairly accurately represent the troughs that have been occurring in price. We also have fairly good and regular nests of lows for the upcoming troughs of these cycles. The only slight anomaly here is this displaced 20-week cycle, circle and whiskers, which you can see has been displaced to the left. The reason for that, as I mentioned in many of these videos, is the fact that the recent average wavelength is calculated over the past 6 iterations of a particular cycle. And so what this tells us is that the 20-week cycle averaged over the previous 6 iterations of that cycle has been running short, and you can see here it is. It is only 13.3 weeks. Of course, we are working with a shorter nominal model, bear in mind, for gold, and so it's not so much a 20-week cycle as I think it should be about a 15-week cycle, but it has nevertheless been running fairly short, whereas the cycles shorter than the 20-week cycle have been expanding, which is why we have the nest of lows going out to the right-hand edge of the chart, and we have this interesting displacement of the 20-week cycle, which is now hovering over this 40-day cycle nest of lows. But again, that's a subject for a different video. The important thing is that this analysis looks fairly good, and the shorthand way of telling that as a matter of interest is to take a look at the composite model line, this dashed orange line, which tells us if we take the cycle information contained in the analysis, superimpose it over price, that is what would have been expected to have happened in price. You can see that the composite model line matches the price action fairly well. Recently, we've had a good deal of extra volatility that is not included, if you like, in that composite model line. That is probably because there's been a little bit of a shift in terms of the peak analysis, but we'll get there in a moment. The important thing is that this composite model line looks really good, and it is showing a good reflection of price action. In other words, the cycle analysis in this trough analysis is looking good at the moment. If I was going to be trading gold right now, I would be watching the trough analysis carefully, because the trough analysis is showing us a very accurate picture of what has been happening in price. And what is happening happening. You can see in terms of the identification of interactions between price and the FLD that we are currently in a category A trade, or at least the most recent interaction was an A category interaction, projecting price to move up. It has probably achieved its target, I would imagine. The next interaction is at this 20-day cycle trough, which it is possible occurred over the Christmas weekend. This gap in price action here is the Christmas weekend. And so it is possible that that 20-day cycle trough has indeed already occurred. But we are certainly looking at price moving up into a peak expected round about here at about the beginning of the new year, according to this analysis. With an 80-day cycle trough having formed in the second week of December, we are still in a fairly bullish mode, as you can see. That is what this trough analysis is telling us. And of course, if we jump into the 6-week view, you can see that in a little more detail. Here is the 80-day cycle trough that formed in the second week of December. Here's our displaced 20-week cycle circle and whiskers, something to be looking out for. But the composite model line is again showing us that we are rising up towards the peak early in the new year. Now let's take a look at the peak analysis. Here is the overview again. And as I've already mentioned, the peak analysis also looks fairly good at this time scale. However, as we zoom in to the shorter time frame charts, here is the 3-month chart for the peak analysis of gold. You will notice that the peaks look fairly good. In other words, they are fairly regular. An important peak has been found to have occurred according to this analysis at this spike high in early December. The interesting thing is that, of course, that peak might need to be displaced a little bit, so we need to not take it absolutely as set in stone. It is quite possible that that peak should be displaced. Where are the next important peaks expected? Here is our 40-day cycle peak, again, just into the new year. I mentioned when looking at the trough analysis that we're looking for a peak early in the new year. That might be that 40-day cycle peak. Here is the peak nest of highs for the 80-day cycle towards the end of January. So that is what we're expecting. Now, is this analysis as good as the analysis in the trough-based chart? In my opinion, the answer to that is no. And a very easy way of telling that, a sort of a shorthand way of telling it, if you like, is to take a look at the composite model line. Here you can see the composite model line was expecting a strong rise up, or at least the information contained in the cycle analysis provided the reason for a strong move up. Of course, now price is expected to drop away from this important cycle peak over here. Look at what the composite model line is doing here. And in particular, let's look at the last few weeks. The composite model line is moving away from price. It's in fact doing the opposite thing. That is an indication, in my opinion, that at the moment gold is responding to cycles that are synchronized at their troughs, much more than it is responding to cycles that are synchronized at their peaks. Could they be the same cycles? Well, that's an interesting discussion for another time. The important thing to bear in mind is that cycles can either be synchronized at their troughs or at their peaks at any time. Of course, it is certainly possible that cycles will change from being trough synchronized to being peak synchronized. We have no idea why that might be or what might cause that, but it does seem to occur in the case of gold. Finally, let's step down to a 6-week view of the peak analysis. And here you can see the anomaly that has started to occur between price, with the composite model line indicating the price should be dropping, whereas in fact price is increasing. The reason why, in my opinion, price is increasing is because gold is currently responding more to cycles that are synchronized at their troughs. And so, to answer the question about gold, I do believe it's important to keep an eye on both analyses. If you are to choose one analysis at the moment, I would certainly choose the trough analysis. I think the trough analysis is giving us a better understanding of what is actually happening in gold. I would stick with the trough analysis analysis and certainly make trading decisions based upon the trough analysis until such time as the trough analysis isn't matching price action very well, at which time I would switch back to the peak analysis and consider whether maybe the peak analysis is giving us a better understanding of what is happening and therefore a clearer identification of trading opportunities for gold. I do hope this video answered some of your questions about gold and trough analysis and peak analysis in gold. Please do let us know any other questions that you have. I look forward to making future videos that answer your questions.